right, good morning. Today is April 12th, 2023, and I'm back with another edition of the Wednesday live show. And lots going on this morning. The CPI number came in as expected, right around 5%. Right, I haven't had time to drill down and look at all the different components in this and that. But what was interesting, well, there's a few interesting things about the CPI. I believe it was back in, I should have pulled this chart up, but back in like 2021, a couple of years ago, right, was the last time that CPI was 5% and it was on the way up. So, and then at the time, everybody noted that inflation was starting to heat up, and I saved a quote from Jerome Powell saying that 5% inflation was not acceptable, right? So that's pretty funny. And then, of course, we all know what happened. Inflation continued to climb, and then got up to, it was like 9.1%. I think it was last June, June's CPI of last year. That's where it peaked. It was either June or July. I knew I should have pulled the chart up, but I'm not going to look for it now. Anyway, I'm sure you guys are all pretty in tune with it. But so inflation, the year over year, I should say, inflation rate has peaked and been coming down since summer of last year. But, it's still, the Fed is targeting 2%. And so what's interesting about this morning's CPI number that came out is the fact that the initial reaction was a significant rally in the futures, right? So, I mean, and we're not seeing that on this S&P chart. Let me just go to SPY here. Yeah. So, you can see the gap up. SPY actually reflects the open better than the SPX. And I don't know why that is, but anyway, we had a pretty decent little gap up this morning, and most of it is faded, right? And the other thing is that everyone was expecting like a huge reaction in one direction or the other. And so far today's range is minimal, which interestingly enough, yesterday was one of the lowest volume days of the year because everybody was waiting for this CPI number to come out. So it was a real dull, low volume, nothing sort of day. And so far today, and of course, the market's only been open a half hour, but so far today, the entire range is inside of the initial overnight pop. I shouldn't say overnight because it happened at 8:30. But anyway, so I guess everybody needs to figure out what this CPI number means. And of course, the big thing is whether the Fed is going to hike one more time in May and then be done, or whether they're going to pause now. There's a new Fed member calling for a pause, and lots of people are calling for a pause because they think that the damage has already been done from the fastest rate hike cycle probably in my lifetime. So anyway, it is what it is, but what's surprising, mostly surprising so far anyway, is sort of the muted reaction today. I sort of thought that, especially after this consolidation zone that the market's been in, I was looking at the overnight futures, and literally for like almost, well, actually over a week and counting, I guess 2, 4, so 7 trading days. We've been in this really pretty tight range. In the overall scheme of things, zoom out a little bit there to give it some perspective. This is another one of those sort of tight consolidation ranges, and theoretically today was going to be the day that that busted it out of this range. And so, but there's still a lot of time left. But it's kind of interesting that when the number came out, I guess a lot of people I think might have expected a bigger move. I pointed this out last week, and everything's perspective, right? If I zoom all the way out to the pandemic sell-off and the subsequent rally, this has got a the look of a bottoming pattern, like it wants to go higher. But at the same time, when I think about the macro picture, when I think, and they say earnings drive the market. Well, um, FactSet is probably the most trusted source for earnings anywhere, and so I'm pretty sure that I saw something recently from them that about how earnings are expected to decline. Everyone's talking about whether the economy's headed for recession. Tons of indicators that in the past have signaled a recession are practically guaranteeing one. And then you have a lot of chatter about, oh, it's what's going to be a mild recession. So anyway, like I just said, the macro picture makes me think that all is not well. I mean, if you pay any attention to the economic indicators, the only good news is that the rate of inflation is coming down, which is good, but that doesn't necessarily mean that the price of stuff's going down. See, I saw something else where like the price of eggs is down, 10% or something like that. But the thing is that the prices, for the past couple years, since inflation reared its ugly head, since they let the inflation genie out of the bottle, inflation of everything, the price of everything's been going up and up and up. And of course, it's always been kind of like that at the grocery store, right? Even when they said there was no inflation, everybody would go to the grocery store and the packaging is smaller, or, the price went up incrementally. The insidious thing about food inflation is that something was 229 and then it's 249, and so you don't really bat an eye because it's nominal in the big scheme of things. And that's what I've noticed over the years, because even when they said there was no inflation, you would see real small incremental things that were like 349 or 379 or 399. And so it's like the proverbial boiling frog when it comes to prices at the grocery store. But which leads me back to the idea that, there was this big thing about a month ago about the price of eggs skyrocketing. And so they pull back a little bit. And then everyone's like, well, disinflation, right? But things like, your car insurance and your health insurance premiums and different things. So I suppose I hadn't really looked to see, what the owner's equivalent rent inflation number. Here's another thing to keep in mind is that, it was for as long as I can remember, um, they they've changed the way that they calculate the CPI several times, and one of which was fairly recent. And so anyway, I mean, you got to take the numbers with a grain of salt. Um, the thing of it is, the rate of inflation. When the rate of inflation comes down, that doesn't necessarily mean that your cost of living comes down. And so that's honestly what most people are concerned about. And so theoretically, well, not theoretically, in real life, in real life, the cost of living has been rising my entire life, right? I mean, literally everything goes up, and that's just endemic, part of the way that things work. So, anyhow, um, market looking relatively constructive here. Obviously, it would make sense to draw some lines on the chart. Um, First of all, let me go back to the SPX here. Remember a couple of weeks ago I drew a whole bunch of horizontal lines on the chart, and there's a lot of good places. The market right now is kind of up against a fairly significant, and I'm going to say, let me pull that up a little bit. Yeah, 4,200, right? This most recent high here is, and the market kind of looks like it's coiling up to test that, to be honest with you. So there's a weird thing on these, and I don't know, my Bing, my Edge browser updated recently. I'm sure everybody else's did. So But the funny thing is, my scrolly wheel on my mouse no longer zooms in and zooms out on the chart, which is kind of weak. It makes it a little more difficult, but we'll just draw some horizontal lines here. We're above 4,000, so that's a pretty positive, pretty positive sign. You know, there's the whole 4,000, 4,100, 4,200. Then there was 3,900. But this zone between 4,000 and 4,200 here is where, most of the action has taken place over the past couple of weeks. And of course, there was this dip, got a lower low here. Originally, I had a rising trend line drawn like this on most of my longer term charts, right? Which made sense at the time. And the interesting thing is that, and we talked about this last week, the steeper that you make a trend line, the more likely it is to get broken, and probably the less valid it is, right? I mean, super steep trend lines always get broken just by virtue of the market trading sideways. And so at this point, I think it honestly it honestly makes sense to use this, because this was a big support area here, right? The 3,800 got retested, so this, and then I'm going to end up with a whole bunch of lines on my chart. This particular uptrend line seems to be the most appropriate at this moment here. So, market has spent a lot of time in this area. I mean, geez, we go back. If I extend this back, and they may or may not be exactly horizontal anymore, but if we go all the way back to last year, right? So let's see, April, just for the fun of it. Okay, so a year ago, April 12th, we were up in, get rid of that. We were up in this area right here. So this was a year ago. So the market is still actually down from a year ago, which kind of makes sense. I mean, there was a lot going on in the beginning of 2022. I believe it was in February, the Russia invaded Ukraine, and that kind of set everything off. And plus, inflation last year was, and the Fed was raising rates, and there was all that stuff that, obviously caused the bear market. And so here we are, we find ourselves, I don't really want to draw a fib on here, but I wish I had looked at that before the show. Anyway, it looks like we're somewhere right around the middle, right around the 50%, retracement from the all-time high to the bear market low. And I like to use intraday highs and lows, generally speaking. That's why I use these open, high, low, close charts as opposed to candlesticks. So I look at both of them, but I like absolute high, absolute low. But anyway, just eyeballing, it looks like we're somewhere sort of right in the middle here. So kind of still in no man's land, right? I mean, there's a lot of time spent in here, and so I suppose it's possible that the market just kind of does nothing, right? It's up a little bit year to date. It's down from the highs. It's up fairly significantly from the lows. It's kind of in this sort of no man's land, and this prior high is sort of the area. It doesn't look like it just wants to rip right through it, but here's the thing: is earnings season starts Friday, I believe. Yeah, I think it's this Friday when the banks start to release earnings, which should be interesting because let's take a look at let's look at XLF first, because that includes all the banks, the large bank, the mega banks. The XLF, I believe, leans towards the mega banks and too big to fail banks and all that. So it's trying to recover from that big sell-off there that we had, last month or whatever. But if you look at the regional banks, it's still like bouncing around these lows, which I find kind of interesting. And I zoomed back so that we could get a little perspective here as far as the actual highs. So I mean, it was already like, selling down and kind of bouncing around, but that sell-off, it hasn't recovered from it, which is sort of a little bit of a caution flag there. The other one, the KBE, this is the S&P Bank ETF. Same thing. It sold off dramatically and is still consolidating down, near the lower levels. It hasn't recovered that much, quite honestly. So it's going to be interesting to see, to see which way this thing goes from here. Let's look at the Nasdaq. We know that the Nasdaq 100. We know that this has been like sort of the strongest index, and so you'll notice on the Nasdaq that that prior high that we're looking at for the S&P, that we were looking at, 4,200 for the S&P, the Nasdaq's already broken above it and has come back and retested it from above and looks sort of like it's holding it. So that's going to be kind of interesting. A lot is going to depend on what happens with Apple. That's going to be the big thing. I have on my chart here, well, they've changed this a little bit. This is pretty cool on these stock charts here. And of course, I'm using the, what's it called, ATP or something version of stock charts, which I actually like a lot. It sort of reminds me of what I used to use. But anyway, there's a place where you can set it to show like the earnings dates, right? So, there's the last earnings date, there's the reaction. So it's going to be a while. It's going to be May 4th, which is, several weeks away for Apple. But if we look at a weekly chart of Apple, is actually pretty interesting. And I don't remember if we looked at this last week or not, but there's a big channel going on here. And if you zoom out on this, this is a weekly chart, by the way. Zoom out on this, it looks like sort of a bull flag, right? But I mean, humongous ranges. But the other thing is, and you know me, I like to look for analogs and or symmetrical patterns. And so you've got, it's pretty obvious what's happening here. You got up, down, up, down, up, and then you've got the little spike high last week, just like you had back here. So that's kind of interesting. Last time, it looks to me like if I line that up with this earnings, it looks like they came out with earnings and and had a big rally on earnings, which followed through for a couple more weeks, and then it peaked out, and then a whole down cycle all the way back to the bottom of this channel. And just recently here, I'm sure everybody's aware that just a handful of stocks has been kind of driving the indexes, Apple being one of them. So it's just kind of interesting. The thing will be, I suppose, the thing to watch is to see if, and obviously, earnings is gonna matter. So I think, yeah, there's several weeks before earnings, so we'll have to wait and see if over the next couple of weeks, if it's able to bust out of here and then earnings come out, and it takes off. Well, that could be one of the things that drives the market higher. But if it were to pull back a little bit and or stay in this, and then earnings come out and has a negative reaction, well then, I see two cycles here that took Apple all the way to the bottom of this, and so this is going to be really important. I just wanted to point that out because Apple is basically the bellwether of the market. So I want to look at something else real quick here, as long as we're talking about some individual stocks. So you guys on the inside know that we had you know that we had a, let me zoom in a little bit here. Wow, that was noisy. We had a pending trade on J&J right here. And so in theory, like once it closed above 157.50, then the following morning it was going to be a buy, right? And so I'm sure you saw the note that I put up. But anyway, long story short, there was no reason to chase this gap. That was too much of a gap to chase. And so at the close this day, I basically noted that, hey, we're not going to chase this gap. We're just going to set a limit. I was looking to set a limit to get in here, 157, 158, and give it a little bit of time to see if it fills. Because sometimes you get like this huge gap up, and 2 days later, it comes right back down and fills the gap. I'm not sure if it's going to fill the gap or not. And whoops, I didn't mean to do that. It's not likely that it's going to fill that gap ahead of earnings. And so next couple of days, this is just going to. Now here's the thing: if you'd been watching that and decided to front run it, well then, hey, great. But for the purposes of what we're doing on the inside, there's no reason. There was no reason to chase that. And you can see here we are, a week later, it's just hanging around, where that gap was. And so basically, it was a buy, as it was sort of emerging from this base here. It was a pretty good looking buy. And so sometimes, the chart pattern front runs the news. Right? And so I haven't really been following the news on it, and quite frankly, I wasn't following the news prior to that, but it was lining up. I mean, it was setting up for a decent potential swing trade. And so, whoops, yeah, there we go. You go back to the daily chart, you can see that it's kind of a typical pattern. Now, of course, it was below the moving averages and all that, but there was just tons of support right here. It was a great technical setup, right? And so, it sat on the pending list for probably a week or two. For a while, it was all set up for a rally up here and then a continuation higher. But then, the news came out or whatever, and so it had that gap. And so basically, it just it's going to have to just get removed from the list. So it is what it is. Occasionally that happens, and it's kind of interesting because you can see on the chart there that obviously somebody knew something ahead of time, right? That's what's kind of weird about these kind of things. So it's difficult to anticipate news, but based on prior patterns here, this was a really nice looking swing trade setup. So that and I just haphazardly drew these lines, but that's ideal. And what would more ideal than this is when you see a pattern like this occurring above the moving averages. But anyway, it is what it is, and so that this one's just going to disappear from the list because it doesn't look like it's going to come down, and if it did at this point, it would probably be really bad news. And so the chart pattern is just busted unless someone was already in the thing. So, and this particular day was the day it pushed through our price there. So, take a look at another one here. Yeah, this one was kind of took a while to to sort of manifest itself, but I don't know. Yeah, these charts, there's earnings there, 426. So far so good. The entry was way back. entry on this one was like way back over here somewhere, and it took a long time to do anything, and then there was this shakeout, which was kind of odd. I mean, that was really strange. I mean, you see that over the years. We've seen that tons of times, right? Where and that was probably a bad market day, and so they try and shake out the weak hands right before it takes off. But anyway, so far so good. Double-digit percentage gain on that one. So, anywho, back to the SPY here, and yeah, I'm not gonna talk much longer, but when you get a CPI number like this, there's a lot to digest. I can't bel I'm quite honestly stunned a little bit that we've still got this little tiny narrow range day happening here, because it's just unusual that the CPI number was what everybody was waiting for, and it seems very unusual to me that so far the reaction is this muted, right? Um, and I say that because lately, and this is this is kind of strange too, but there's been a few days lately, and when I say that, I mean by I guess over the past few weeks or something, where the S&P volume has been almost like holiday volume. Now we did have the Good Friday holiday, and maybe it was this day. I don't know. One of these sort of narrow range days. I read that it was like the second lowest volume of the year, which seems odd because April is typically, a really active month. And so I these low volume days, like yesterday and the more recent one, maybe it was this day here, the narrow range day, but I usually attribute those to, either right around a holiday or right before the Fed, right before the Fed announcement, or right before, the CPI or something like that. But yeah, I'm a little bit surprised. Yeah, the only thing that I can think of is that, everything was kind of the market rallied in anticipation of the CPI number, and now it's sort of just reached a plateau here. And now we're waiting for earnings season. It's like we're always waiting for something that's upcoming, and that's it's kind of an odd sort of thing, because why is the market not doing anything? Well, it's waiting for something that's going to happen, soon, in a couple of days. And so, up till now we've been waiting for the CPI, and then nothing happens, which I think this is the opposite of what probably everyone expected, and that's why so far. And of course, we're only an hour into the session, but that's why so far it's such a narrow range, sort of dull day, is the market's just sort of digesting it. And then I believe Fed minutes or something like that. The FOMC minutes from last thing come out today at 2. So, um, the market likes to price in stuff, and then they say, well, everything's priced in. And so, in theory, the CPI number kind of looks like it was priced in. So, what's priced into the market, and this is always really interesting, is that one more Fed rate hike, and then I think that, and there's the bond market, I suppose, prices in the it's pricing in like rate cuts, and which is kind of interesting. And the Fed keeps saying they're not cut, they're gonna raise rates, and maybe they got one more left, and then they're gonna pause, and then they're gonna hold them there the rest of the year, is what they've been saying. But the market is saying no, that the economy is weakening, and that they're gonna end up having to cut rates. So, in all my experience doing this, I know that the Fed loves to cut rates. And so now they've hiked enough that they can actually, if things start looking dicey, they can start cutting rates. So that was always their biggest problem. Back when Yellen was the Fed Fed chair, they would raise 25 basis points and then pause or hold off. There was always something in the news or something happening that they were like taking baby steps and that type of thing. And so, and this is obviously pre-pandemic, but they never raised rates enough to be, they never had a rate hike cycle. The last one I can remember was like 2018 or something like that. Was it? I think it was 2018 is when they thought that they were going to raise rates. And but anyway, they never embarked on like a real rate hike cycle to where they hiked enough that they could start lowering them again. And so now they have that ability. So, or going forward. So obviously the bond market is saying that they're going to cut rates, once or twice towards the tail end of the year. So, you can make a bull or bear case for the market, and we're in a pretty confusing time because there's so much geopolitical stuff going on, and the macro picture is extremely cloudy. The technical picture, I mean, this is kind of, it looks kind of bullish to me, but hey, what do I know? And so, once again, all you got to do, and keep in mind that the Nasdaq has already broken above that. So, you got that level, you got, sort of, you can put this wherever you want. You can put it right below that low. It would kind of make sense to put it right there and there, but we know that this is, that's like mega, mega, mega support. So, and it's a long way down, obviously, but we're much closer to breaking out. And then, of course, there's this little spike high up here, and so that's another humongous. There's still a lot of overhead. There's tons of overhead resistance, and so I don't know what can break the S&P through all this overhead resistance, other than Apple knocking the ball out of the park in like these mega cap tech companies or whatever, coming out with great earnings and just taking off. And so, but it kind of seems unlikely, and so. I don't know. Um, I'm not gonna try and predict where the market's headed. I just know that there's significant overhead resistance in this whole zone here, basically. Like, this whole zone here. There you go. So close enough. And then of course, there's tons and tons of support below. There's the 50-day moving average. There's the 200-day moving average, which by the way is sloping up now. So there's a lot of potential black swans floating around out there too. And we've seen that before, right? The market, everything's going along just peachy, big rally like back here. You get a couple of days and, something comes up. Typically it's based around the Fed, but something comes up and then we know that the market can, takes the proverbial stairs up and the elevator down. And so you don't want to assume that there's like no risk at all, but there's a lot of cushion below. So things are looking pretty good. Um, and it gets more ahead of earnings season like we're in. Like literally every company's getting ready to come out with earnings, so it becomes a little bit more difficult to find decent trade setups ahead of earnings, but we'll cross that bridge when we get to it. So anyway, thanks for tuning in. I will see you back here next week. Same time, same place.